Welcome to this episode of our 3-Minute Investment. We help you easily understand the financial reports of popular companies. For decades, the market viewed advanced micro-devices as the eternal underdog, the budget option, the second choice. While the world focused on other tech giants, this company executed one of the most significant strategic pivots in semiconductor history. We are looking at how a former PC component manufacturer transformed into the backbone of modern AI infrastructure. The financial statements reveal a fundamental identity shift. Revenue streams have migrated from consumer electronics to enterprise-grade data centers. The company has decoupled its future from the volatile personal computer market, anchoring itself instead to the booming demand for cloud computing and artificial intelligence. The numbers tell the story. In the most recent fiscal period, data center revenue more than doubled, surging over 120%. This segment now drives the company's growth engine, capturing significant market share in territories previously dominated by a single monopoly. This success stems from a specific engineering philosophy called chiplet architecture. Instead of manufacturing one massive, expensive processor, engineers build smaller, efficient components and stitch them together. This approach reduces manufacturing waste and lowers costs, allowing the company to offer superior performance for a fraction of the price. Major cloud providers have taken notice. The world's largest hyperscalers have integrated these processors into their server fleets. They choose this architecture not just for speed, but for energy efficiency, a critical metric when running millions of servers around the clock. Beyond traditional servers lies the new frontier, artificial intelligence. While competitors focus heavily on training AI models, the learning phase, this company targets inference. Inference is the operational phase, where the AI actually generates answers and performs tasks for users. To win in inference, memory is key. The new MI300 series accelerators feature massive memory capacity, allowing companies to run colossal language models on fewer chips. This efficiency creates a compelling operational advantage for tech giants deploying AI at a global scale. This shift to high-end enterprise hardware has profoundly impacted profitability. Gross margins have expanded significantly, reaching 54%. Selling premium infrastructure technology commands much higher returns than selling consumer processors, structurally elevating the company's financial profile. Higher margins generate robust free cash flow. This liquidity fuels aggressive acquisitions, such as the purchase of ZT Systems. By acquiring specialized rack-scale design talent, the company can now deliver complete supercomputing systems, not just individual chips, accelerating deployment for customers. China historically represents 20 to 25% of the global semiconductor market. The inability to sell high-end AI chips there effectively reduces the total addressable market. While demand in the US-EU is currently unlimited, supply constrained, in the long run, the loss of the Chinese market is a structural headwind that limits the ceiling of growth compared to a free trade scenario. In addition, software remains the primary hurdle. The competitor's proprietary ecosystem is deeply entrenched. However, the open-source alternative is maturing rapidly. As standard AI frameworks become hardware agnostic, the barrier to entry lowers, making the hardware alternative increasingly viable. The trajectory points toward a massive opportunity. With the total market for AI accelerators projected to reach $500 billion, capturing even a fraction of this demand represents exponential growth potential. The financial data suggests a company well-positioned to power the next generation of computing. While the data center grabs headlines, the consumer PC segment is entering a new cycle. The integration of neural processing units, or NPUs, into laptops is sparking a refresh cycle known as the AI PC. This technology brings AI capabilities directly to the device, reducing reliance on the cloud for smaller tasks. Conversely, the gaming segment is navigating a predictable cyclical trough. As the current generation of gaming consoles matures, hardware sales naturally taper off. This decline acts as a temporary drag on total revenue, masking the explosive growth occurring elsewhere in the business. The embedded segment, bolstered by the acquisition of Xilinx, provides stability. Serving automotive, industrial, and aerospace markets, this division operates on long life cycles that are less prone to the rapid obsolescence seen in consumer tech, diversifying the company's risk profile. In summary, the transition is complete. No longer just a budget alternative, the company has established itself as a technological leader in the data center. While risks remain in software and geopolitics, the alignment with the secular trends of AI and cloud computing suggests a trajectory of sustained relevance and growth. Thank you for watching. Let us know what companies you want to know more about in the comment below. Please subscribe for more financial analysis to rocket your investment.